Deductions and Credits, Maximize Tax Savings, Tax Management Mastery Ep 2. Let's delve deeper into each sub-segment, ensuring a comprehensive understanding by highlighting at least 2 key points in each area. As Professor George, my goal is to provide you with actionable knowledge that empowers your tax-saving strategies. Understanding tax deductions. Standard deductions. Adjustment for inflation. Each year, the standard deduction amount is adjusted for inflation, which can subtly increase your tax savings over time. For 2023, for instance, the standard deduction for single filers and married couples filing jointly has increased, offering more non-taxable income. Simplicity versus benefit. Opting for the standard deduction simplifies tax filing since it doesn't require itemization of expenses. However, it's crucial to assess whether the standard deduction outweighs the potential benefits of itemizing, especially after major financial events like purchasing a home or incurring significant medical expenses. Itemized deduction. Mortgage interest deduction. First, only the interest on mortgage debt up to $750,000 is deductible, which is pivotal for new homeowners to understand. Second, the interest on a home equity loan can also be deductible if the loan was used to buy, build, or substantially improve the taxpayer's home that secures the loan. Medical expenses. Firstly, only out-of-pocket expenses not reimbursed by insurance can be considered. Secondly, it's vital to aggregate all possible medical expenses within a year, including travel expenses for medical care, to surpass the 7.5% AGI threshold for deductibility. Charitable contributions. Charitable contributions are not only limited to cash donations. Non-cash donations, such as goods to a thrift store or stocks to a nonprofit, are also deductible. Additionally, for those who itemize, cash contributions to qualified charities can be deducted up to 60% of AGI, offering a significant opportunity for tax savings. Exploring tax credits. Earned Income Tax Credit, EITC. Income threshold. The EITC is available to low to moderate income earners, but the exact amount of the credit and income thresholds vary based on filing status and the number of children. This variability underscores the importance of checking eligibility annually. Refundable nature. Unlike deductions, the EITC can result in a refund if the credit exceeds the amount of taxes owed, making it a critical component of tax planning for eligible individuals, particularly those with children. Child tax credit. Credit amount and phase-outs. The child tax credit offers a substantial credit per qualifying child, but it begins to phase out at higher income levels. Understanding these phase-outs can help plan for the potential impact on your tax return. Additional child tax credit. For those who don't owe any tax, the additional child tax credit may provide a refund, emphasizing the need to understand the full scope of tax credits available to families with children. Education credits. American Opportunity Credit versus Lifetime Learning Credit. The American Opportunity Credit offers a credit for the first 4 years of post-secondary education, with a portion being refundable. In contrast, the Lifetime Learning Credit is non-refundable, but covers a broader range of education expenses, including graduate courses. Knowing the differences can guide which expenses to claim. Qualifying expenses. Both credits have specific qualifications for what constitutes an educational expense, including tuition and required fees. However, room and board, medical expenses, and insurance do not qualify, highlighting the importance of distinguishing between eligible and non-eligible expenses. Strategies for maximizing deductions and credits. Timing of expenses. Bunching deductions. Aggregating deductions such as charitable contributions or medical expenses into a single tax year can help surpass the standard deduction threshold, maximizing tax savings in specific years. Prepaying expenses. Prepaying deductible expenses, such as property tax or state income tax, can increase itemized deductions in a particular year, offering strategic flexibility in managing tax liabilities. Qualifying for credits. Adjusting income. Sometimes slight adjustments to your income through retirement contributions or other pre-tax deductions can help qualify for certain tax credits, underscoring the importance of income planning. Education credits planning. By strategically claiming education expenses under the American Opportunity Credit or Lifetime Learning Credit, taxpayers can maximize their education-related tax savings, emphasizing the need for careful planning and documentation of education expenses. Avoiding common mistakes. Overlooking potential deductions, credits, state and local taxes, SALT. Many taxpayers miss the opportunity to deduct state and local taxes paid, including property taxes, and either state income or sales taxes up to a limit, which can be a significant deduction for those in high tax states. Non-cash charitable contributions. Taxpayers often overlook deductions for non-cash contributions to qualified charities. Keeping detailed records of the value of donated items can. Today we've explored how understanding and applying tax deductions and credits can significantly reduce your tax liability. Remember, the key is to know which deductions and credits you qualify for and to maintain thorough records. I encourage you to review your tax situation with these strategies in mind. Consider consulting with a tax professional to ensure you're maximizing your savings. For more personalized advice, don't hesitate to visit BauerAccounting.com or reach out directly at GeorgiaBauerAdvice.com. And if you found today's episode helpful, please subscribe to our channel for more invaluable insights. Thank you for joining me, Professor George, in this episode of Tax Management Mastery. Stay tuned for our next episode, and remember, efficient tax management is within your reach. Goodbye for now.